Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Wednesday. It's January 25th. January, the first month of the year, is almost behind us. We got like a week left. It's about 8:14 in the morning, and the market's going to gear up to open up in about an hour and 16 minutes. Now, as everyone knows, it's earnings season, earnings, and the stock market was very mixed yesterday, but look at it this morning. Dow's down already 225 points. The NASDAQ 100, which has 3 times less value than the Dow, is down 161 points, which would put the Dow at about 450 points down, which is significant. Why is this all happening? Why are we having such a roller coaster? Because of earnings. So yesterday, 3M reported, Microsoft reported, Capital One reported, D.H. Horton reported, F5, GE, Halliburton, Johnson & Johnson, Lockheed Martin, and I can go on and on and on. And today, you've got Tesla, Abbott Labs, AT&T, ADP, and here's all the expectations so you could see what they look like on this side. Ethan Allen, General Dynamics, IBM. So you've got a lot of volatility. This is not a time to be a hero. We have to be very, very selective because we're going to have a lot of non-directional volatility. That's the first thing I want to bring to your attention. The second thing I want to bring to your attention is the fact that the bond market, remember we never got a chance to sell it when it was at the, right here at the 108.84 level. Well, it looks like it's coming up. I don't know how sustainable this will be, but I would really love to see it go at the 110 area because anything above 110 and a half, I'm selling this sucker. The RSI is just over. It's going to get overbought. Let me just show you what I'm talking about, and we will end up selling it. See how it's starting to get a little uppity. If it goes up here, it should go above these levels, and it should give us a overbought level. So it's one of the factors that I'm looking at. Keep your eye on that. I'm also looking at volatility. Volatility looks like it's bottomed out. This is a 9-month, well, actually, let me show you a year chart. This is a year, and it looks like we've bottomed out right here. Notice the low went a little bit lower. As I've mentioned to you, this is all algo. Algos love to break the lows, sucker a bunch of weak hands in, and then take us higher. I think we've bottomed out. I think volatility is going to go higher, and markets are going to go a little lower. Let me go into the pre-opening to tell you what we're expecting, a little bit about earnings, and then I'll get into the technical nitty-gritty for you. A lot to report today. So U.S. benchmark finished mixed yesterday. That's right. We were weighted down. NASDAQ indices were weighted down by healthcare, technology, oil, and gas sectors, while the Dow ended higher, mainly because of telecom, utilities, and industrial, the blue chip stocks, which I'm not really all that hot about right now. In yesterday's session, we have third straight gain of day of gains in the Dow. We had S&P and 500 closing lower. Right now with earnings, it's very hard to gauge because remember, the Dow only has 30 stocks, so it's very easy for it to get out of whack. You've got 3M, Johnson & Johnson, Verizon, General Electric, PCAR, and Microsoft. And yesterday, you had manufacturing and service PMI data that showed that slower than expected pace in the first week of the year, but the Richmond Manufacturing Index dropped to a 2.5-year low, weaker than the expectation of -5. Now, fourth quarter earnings results are in full swings. While investors are awaiting new earnings results from major global companies, you've got Tesla, Abbott Labs, AT&T, IBM, Boeing. Oh boy. And the number keeps getting worse and worse. And this is why I don't understand why the market's getting stronger, or at least appears to be getting stronger, because the numbers are actually getting worse. In the beginning of the year, we were looking for a drop of 1.6%. We're now, and I mean, look, we're only 25 days into the new year. We're now expecting a drop of 2.9%. That's almost twice as much as expected 25 days ago, which means earnings are not up to snuff, which means we should be cooling off. And remember, we just got into the hearts of earnings. I'm not seeing anything fall off the cliff, but there's a lot of red flags, which I'll talk about when we get into the technicals. Today, we're going to be looking at crude oil inventories in just a little while. They're expecting 0.971 million compared to 8.48. So we're looking for higher inventories. That'll be interesting. Europe, regional economic activity was reinforced expectations that the European central banks would continue to hike rates to tackle inflation. Nothing really new there. The Japan Nikkei hit a one-month high amid continuous bets on the Chinese economy, COVID, And markets are anticipating that a week-long holiday will boost economic growth in China, especially after the country lifted most of its COVID restrictions. I'm just looking for my cat Bonnie. He was here a minute ago. And pre-market, you've got ISRG dropping 9% pre-open. Philip Morris is up 1%. Microsoft is down 2% after reporting better than expected numbers. And Spotify is down. So the earnings yesterday could not hold us up. And as you could see today, oh boy, where do we start, right? Tesla, Seagate. I mean, I could just throw a dot. IBM, Boeing. You've got a lot of earnings, so it's going to be an interesting time for the market to digest things. But looking at things technically, things are not looking all that great. Let me explain to you why. This is the QQQ, right? This is what everybody's betting on right now. Well, folks, it's still trading below the 200-day moving average. And it's actually starting to peak out at the 200-day moving average. Look at that right there. The RSI, overbought. Looks like it's peaking out and coming back down. And we're still in a long-term downtrend. That's number one. Look at communication service sector. This has a lot of FANG stocks in it. Look at that. Overbought. And it looks like we're breaking out, right? Well, not so fast. Let's look at the RSI there. Where's my Roger template? There we go. Just eliminate this. Yeah, there we go. So look at how this looks. Look at where the RSI is right here. It's a double top. And again, 200-day moving average. Right at the 200-day moving average. Look at XLY. Discretionary. Way below the 200-day moving average. Also getting overbought, but barely getting out of the range. And look at technology. Also right at the 200-day moving average, and it looks like it's ready to cool off. Now, yesterday, if you were in my VIP room, I was showing you momentum levels, and I was showing you how communication services is now 88 percentile. This was like at 75, and this was about 75, and information tech. But look at communication services right now on a longer-term basis. Here we go. Look at where we're at right now. Look at a 5 years on communication. So internally, we're overbought, right? Looking at it, and this has Google, Netflix. If this goes down, I promise you, the rest of the market will go down with it. Oops. So that's so internally, you see how overbought it is. Technically, we're right at the 200-day moving average, and we're ready to bounce lower. We're ready to go to the downside. So to me, this is very, very bearish. And if you look at the SPY, which we will look at right now, it's also bouncing right off of the 200-day moving average, which is right here. So I'm seeing the market suckering us in, and at the same time making it look like we're going higher, but we're not. We're actually going lower. Nothing is here is pointing higher at all. NASDAQ, S&P, things are pointing to lower momentum levels. And if you look at momentum levels right here, you will see that overall, you'll see here that you have a lot of red, 45%, 40%, 37%, 36% in consumer staples. There's a lot of vulnerability in this market. And if you look at the NASDAQ 100, only 58% are trading above the 200-day line. Dow, 55, 57, not all that great right now. We're tethering. Russell 2000, 48% are trading above the 200-day moving average. And remember, the small caps are supposed to lead us out of here. So I'm just not seeing all that buying accumulation that investors believe will be coming in. Looking at each individual sector, I would stick with energy, basic material, industrial. These three will treat you well. Communication services, technology, consumer discretionary, not liking right now at all. I think real estate may be an opportunity. It's a little over. It's a little to the downside, not to the upside. It's a little overbought still. But if we look at these sectors, I just want to show you where the RSI is in comparison. So if you look at financials, for example, and what I'll do is I'm looking at a 5-day RSI that's at, let me just put the RSI at 20 and 80. Let me put a 5-day RSI, and I'll put this at 20, this at 80, and this at 40. There we go. There we go. So you could see it better. See, overbought. 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 This is way overbought, coming down. Don't let the market sucker you in right now. Overbought and still coming down to the downside. Look at XLI. Overbought and then now starting to come down again. So momentum levels are not going higher. They're going lower in light of earnings, which is telling me that earnings are not coming out better than expected as of yet. And estimates are lower. So we got to be very, very, very cautious. Now, in terms of giving you guys a trade for today, I'll gladly do it, and I'll show you why. If you look at the energy sector is actually holding up pretty well. It's still trading above the 50-day moving average. And if we look at the top stocks, you will see they're energy stocks. Now look at this volatility yesterday, this volume. Craziness, right? So what you may want to do is stick to something a little less volatile, like, for example, let me show you a good one here. A good, stable one. Halliburton right here. Whoops. Halliburton right here. Not a bad stock. Should treat you well to the upside. Also, I like the healthcare stocks again. I think healthcare is going to rally. And I like Lamb Weston, LW. I think the stock is going to rally. They're still the strongest stocks. In terms of the weakest stocks, that shouldn't be a surprise to you. Dish, DI. Dish is a dish served cold or bearish. I think it's going to go all the way to the $13 level. I wouldn't be surprised if we saw that in the next couple of weeks. And also this VNO, Vornado Realty Trust, I think it's going to break down and go all the way to 20. So I think VNO and Dish are your safe bets in this type of environment. Folks, I got some great news before I let you go. I'm reopening enrollment in a very, very special class. It's a 3-part virtual workshop on how to build your own Frontrunner portfolio. You'll learn the inner workings of how to optimize a portfolio based on hard, back-tested data, how to customize your own ETF, the core factors behind Frontrunner stocks, and the selection process. I know you're going to love this workshop. It'll equip you with some of the best trading tools available and help take your skills to the next level. Click the link below, check it out now, and remember, post your comments in the YouTube Wealth Press channel. Send me email, support@marketgeeks.com. I want to hear from you, and I'll talk to you later. And remember something before I let you go. No monkey business, right? No monkey business during earnings. Pay attention. None. I'll see you guys later. Bye.